All right, welcome back to AI for 2021. I hope you're having an amazing time so far. Our next session will be led by Peter Golden. He is an AML transaction monitoring executive at USAA. Please join me in welcoming Peter to our virtual stage.
All right, hello, good afternoon, good morning, or good night, depending on where you are in the world. Thank you for taking the time to come and listen to my virtual presentation on AML and finding a $300 million needle in a haystack. Let me share my screen real quick and we will be ready to get going. As Patrika said, my name is Pete Golden. I am USAA's AML, anti-money laundering transaction monitoring executive. What do I do in my day-to-day? I lead a team of quantitative experts that are modelers, data specialists, and technology specialists that work for basically finding money laundering whenever it's happening and making sure that we report on it to the required authorities. So what I'm going to do today is I'm going to walk you through a little bit of what is money laundering. I know we've got folks from all sorts of different backgrounds, so I just want to ground us in what the actual problem is. Why is this a big deal? Why do we care about it? Why do we have institutions that spend a lot of money and a lot of efforts at trying to find it and report it and stop it wherever possible? And most importantly for AI4, how are we using AI, or how can we use AI to do a better job of this, be more efficient, be more effective, and bring us into the future? I will be honest, there's a lot of challenges. I think this is an exciting area because of those challenges. But we really need smart folks like all of you at this conference to help us in moving forward in leveraging new technologies and new approaches to really get a handle on the size of this problem. So let's start with a little bit of money laundering 101. So pretend you are a money launderer or you are an aspiring money launderer. Basically, you start out as a criminal of some kind, doing some kind of predicate offense, selling drugs or being engaged in other criminal activity that produces money that you want to be able to spend. Now, being a somewhat competent criminal, you know you can't just walk into a bank with a duffel bag full of dirty $1 bills and expect to be able to use it to buy a Ferrari or do all sorts of bad things. Instead, what you have to do is find some way of getting that money cleaned so that you can go off and do all sorts of different things. As an FBI agent, I knew once said, what's the point of doing all this crime if you can't spend the money? So money laundering is that act of taking your dirty proceeds and making it clean. Well, how do people do that? From a high level, there's three main stages. The first is called placement. So you have your proceeds from selling your drugs. You have to somehow get it into the financial system. So as much as I might joke about walking into a bank with a duffel bag full of cash, things like that do happen. Usually there's a little bit more sophistication, but some way or somehow they have to take those proceeds that they got from doing not good things and put it into the financial system, and that's called placement. The second stage is you have to get a bunch of your other friends of money and mix that dirty money with the clean money, and this is called layering. So the intention here is to make it really hard to see where the dirty money came from. And so you're going to transfer among accounts. You're going to go from institution to institution. You're going to do all sorts of different things that you can to mix dirty money with clean money so that it's impossible to tell, hey, what was coming from a bad source and what was coming from a legitimate source. After you've done some sufficient amount of layering, you're going to move on to maybe taking a credit card and buying a house or buying a motorboat or submarine, exotic pets, whatever you want to do. That's the integration stage where you've got money that you think is cleaned and you want to go out and actually go use it out in the world. So that's it. 3 stages of money laundering. What's the big challenge? Well, as you go through these stages, the whole purpose of doing this is to make it harder for us to detect when you've got criminal proceeds. So the longer you go, the harder it is to detect. So we're trying to find it earlier on. And the other thing is, absent the source of those funds, so absent the fact that you've got $1,000 from selling drugs, it's really hard to tell that $1,000 moving throughout the system is different from any other money that you might be moving around. In other words, a lot of the steps individually would normally be totally legal activity, except for the fact that it's coming from a bad source. And because of that and the intention to obscure where the money is coming from, that causes a problem that we have to deal with. So how much, like, does this actually happen a lot? Is this really a big deal? I would argue yes. So a couple of big numbers here. 800 billion to $2 trillion. That's the amount that the United Nations estimates is laundered every year. So that's 2 to 5% of GDP. There are people that can kind of argue about where these numbers really come from. Are they a bit inflated? But it's a lot of money, no matter what. Like, the best estimates are there is a ton of money heading all around the world that is dirty, that's being involved in money laundering. 277,000 plus. That's the number of suspicious activity reports that were filed in June 2021. I'm going to go over a little bit of like what we do in an AML department. But a SAR, or suspicious activity report, is the main form in the United States that we have to file to FinCEN, which basically says, hey, we think we found something which might be money laundering or might be some other kind of crime. So you can tell that that's a lot happening every month, and that number is just continuing to go up month over month. And then the last bit, which is why is AI important to all this? 95%. That is the canonical false positive rate of our traditional anti-money laundering systems. In other words, taking your average kind of current system and current set of processes that a bank or other financial institution will use to look for money laundering, 95% of the stuff that we're producing from those systems is garbage, is a false positive. There's a lot of reasons for that we'll go to, but no one is really happy about it. There's tremendous amounts of money spent on calibrating these systems, setting them up, maintaining them, and paying for the investigations that go through there. And a tremendous amount of that money is frankly just being wasted because it's very hard for us to find what is the stuff that we should be focused on versus the noise in the system. The number that I left off of here and that I kind of put in the title, about $300 million, that is a very, I won't want to say reasonable, but that is in the range of the types of fines that institutions find themselves paying. It's not the largest AML fine that's ever been levied against a given institution. That's over in the $1 billion range. But if you have severe deficiencies in your AML department, if your systems are not working even at 95% false positive rates, or you can't justify how they are calibrated and configured, it becomes very painful very quickly once the regulators kind of lose that confidence in what you're doing, and they can really make you hurt. So hopefully you'll agree this is something that's worth spending some time trying to get better at. All right, so anti-money laundering 101, and I promise I'm going to get to the AI stuff in just one more slide. If you take the 30,000 foot view of what the heck do we do, I broke it down into these 4 steps. So first is ingesting of data. So we're going to go out and get all sorts of data throughout our departments. For instance, I work at USAA. We have a bank and an insurance company. So every month we're going to be ingesting all of the fund transfers that are happening, the wires, the deposits that are coming through, hundreds of millions of transactions, as well as all of our customers and account data, all kind of getting ingested on a monthly basis. We're going to monitor those transactions. So that means we're going to apply business rules or models to try and find, okay, what's potentially suspicious, generate what's called an alert most times. And then those alerts are going to be investigated and worked by trained specialists that kind of know what types of things to look at, what are the red flags associated with money laundering, and they're going to make a determination on whether or not we have to file a suspicious activity report. So the SAR that goes off to FinCEN, which then gets distributed to places like the Department of Justice, FBI, CIA, NSA, all these different groups in the government that want to know when there might be suspicious activity going on, and law enforcement agencies and intelligence agencies that might decide to do something with that. So that's, in a nutshell, at a very high level, kind of what we do from a transaction monitoring perspective. I broke apart these 4 different areas because I think there's ways that AI can help supplement, support, or improve all of these different areas. And we're going to go through some use cases now about where that might fit in terms of what the state of the possible is right now and what it might be in the future. So I'm going to jump around a little bit. We're going to start with monitoring because that's where everybody, frankly, goes to first in terms of thinking of new techniques. So I talked about false positives, 95% false positive. I don't think there's anything else in the business world where we would live with 95% false positive rates as something that we just say, oh, that's the cost of doing business, and not have some different approaches to doing that. So you go, why? Okay, why is it like that? Why is it broadly accepted that that's the false positive rate? Well, the first thing is the traditional techniques that are being used here are really, a lot of times are pretty basic business rules. So in other words, I might have rules that look for wires that are going to or from a high risk jurisdiction. So if you do 3 wires in a given month and they total more than $10,000 to a given jurisdiction, generate an alert. Or you might have a rule that looks at cash withdrawals. If you pull out more than $10,000 in a given month and you do that 3 times, generate an alert. There's all sorts of different variations on what those thresholds and specific parameters are. And those are very kind of closely kept to a given institution as to what the exact numbers are where they generate those types of alerts. But at the end of the day, you have pretty simple logic that's being used to try and generate all these alerts. As you can imagine, money laundering is way more complex than that. So if you're using simple logic and kind of very linear type approaches to try to detect money laundering, you're going to be catching a lot of stuff that's just normal activity, along with the very rare needle in the haystack that you want to find, which is actual money laundering activity. And you go, okay, well, why haven't we just replaced all that stuff with like machine learning or some AI or something else like that? Well, the truth is it's not as easy as all that. I'll just give you a little bit more background on working in a highly regulated organization, sort of the way that the AML regime is set up in the US and in most places around the world. So banks and other financial institutions are essentially deputized by the US government to go and look for instances of money laundering within their customer base. There's a number of different laws, the BSA, Bank Secrecy Act, being the main starter of this whole kind of regime. The Patriot Act was a major revision of that back in 2011. And then just at the end of last year, there's a new AML Act, which is kind of added to that. But these laws have gone out and said, hey, you have a requirement, an obligation to go put all this forward. The folks reviewing the SARs, the people at FinCEN, it's mostly law enforcement and intelligence folks, I think we get a sense that a lot of times they really want more data is better. It's more useful for them, and they're not paying for it, right? They don't have to worry as much about the efficiency. They just want to make sure they're getting all the data that they need so that they can go out and, do their jobs, which we all respect and appreciate that they do to keep us safe and to look for this activity. So they're not really focused on efficiency, or as long as you're effective and you're capturing everything. The other thing is, being in a highly regulated industry, the groups that regulate the banks and the insurance companies, things like the Fed or the OCC, those are prudential regulators. And their main concern is making sure that the financial system is healthy, that the different institutions are healthy. And they want to make sure that you are properly addressing the risk that is throughout the system. Obviously, money laundering poses a systemic risk to the health of the financial system. Kind of crime tends to crowd out good business activity and has a bunch of other deleterious effects. So they're really focused on making sure you capture everything and you don't lose anything. And so sometimes it can be really, really challenging to innovate or to try and do new techniques, because they just want to be sure that you're being safe and sound in how you are operating. So one of the main advantages of these business rules is very clear to kind of explain the types of things that you're monitoring for, and you can explain that to a regulator and show that you're doing the right thing in terms of your coverage by using that. If you start getting into, hey, we're going to use deep learning and a bunch of neural nets, and we don't really understand why it's producing the outputs it's producing, but it looks like it's pretty effective. I think you can get there. I think you can get people on board with that, but it's going to take a long time, and it's really quite difficult to do. So those are some of the challenges in just saying, oh, we're going to replace the business rules with AI, and that's going to solve all of our problems. The last thing I want to say about what makes this a challenge, and I promise we're going to get to like some of the good stuff that's going on today, is what's truly useful. So I talk about, we file SARs and they go off to FinCEN and they get used, by the different organizations. Well, if you see the numbers, we're filing as a country, we're filing millions of these suspicious activity reports every year. Not all of them are being used in actually prosecuting people or in investigations. And in fact, we actually don't know which are useful and which aren't. Certainly you've got your bucket of things that you file on where you go, okay, we're pretty confident that this is some bad stuff going on. And usually those are accounts that you close and exit the relationship with the customer. However, you don't have a feedback loop for what SARs you filed and how many of those did FinCEN think were good and provide law enforcement value versus what we filed because we weren't sure and we want to make sure that we're providing the government the information that they need. So without that feedback loop, it's really hard to say, hey, what do I cut out and what do I not cut out? So even if you have a sophisticated model or a sophisticated technique, if you're training it on something and you really don't know what's good or what's bad, you're just going to end up having a more sophisticated way of getting the same types of false positive rates as you did in the past. So there's a lot of challenges and there's a lot of reasons that we've got those high false positive rates. With that said, there is reason for hope. There's different techniques that we're finding are pretty meaningful in being able to enhance and add on to our systems. And that's one nice thing I will say about the regulatory environment is usually you can add on to what you've got and people are open to that concept. It's just really hard to add on or replace something which has existed for a while. But one of these add-ons is network analysis or link analysis and being able to look at different connections between accounts that a customer might have and all the people that they're connected to. So instead of looking at like one transaction or a set of transactions you have in an account, I'm looking at relationships between different groups over time and basically building a network graph to see where those relationships are. And then I can figure out if any node in that network graph turns bad or I have suspicion around, well, hey, let's propagate that out and make sure that we're covered all around. So one area where this can help out is when there are occasional data dumps, like in the Panama Papers that came out, where you just had gigabytes of data that were dumped all at once about these offshore shell companies. Being able to plug that into your own network graph of your group of customers, you can very quickly see where you might have either relationships that you weren't aware of that might be of note, or things that you might want to focus in on in terms of networks that are present that you might want to really close in on. So link analysis, network analysis, and this is really enabled by the ability to process a lot more data in a quick way, and things like MongoDB or NoSQL databases, which allow that kind of processing and the connections that are occurring that I think even 10 years ago, 15 years ago, just wasn't possible in any kind of meaningful amount of time. So other areas that in the monitoring space that is being really helped out by more modern techniques are things which are not necessarily the business rules or models themselves, but some of the stuff that goes around that can maybe help us polish and refine what's coming out of it. So the first area would be in our customer risk scoring and our segmentation that's going on. So you have a requirement to risk score all of your customers if you think they're high, medium, low risk is normally how people do it. You can have different kind of grades, but you have to give everyone a score and try and figure out, okay, who are your higher risk customers, and usually put some more stringent controls around those folks. Well, similarly, you want to segment your customer base into different groups that have similar transactional activity. so that you can tune your rules appropriately. So in other words, you don't want to have your pizza parlor be monitored the same way that you monitor, say, a minor account in terms of how much cash they're going to be depositing or pulling out. You're going to have bad news either way. Either you're going to set parameters too low, and then you're going to have just an explosion of alerts that are not useful. You're going to set them too high, and you're going to miss out on actually suspicious activity because it's being swamped by the activity that's going on in the business. So you want to be able to set these clusters of different groups that have similar transacting behavior. Traditionally, that's just done by, breaking individuals apart from businesses, maybe breaking your high net worth individuals apart from your retail business. So very kind of business line specific, and just doing business rules to set that up. However, we can use things like clustering analysis to actually have a more scientific way of breaking apart, okay, what folks and what attributes tend to say these folks are higher, higher transactors versus lower transactors, and then use that to feed into the tuning that happens with our rules. And that's great because that's using just a standard technique, which is applied in all sorts of different applications. But here for the AML context, it helps you get better results out of your traditional monitoring just right out the bat. Another area, and I think probably the most beneficial area for monitoring is alert risk scoring. And this is taking that 95%, really the 100% of all those alerts that you're generating, and trying to find out, okay, where is the 5% of good stuff coming out of here? Can I apply something which actually can figure out what's most likely to be in that 5% of useful stuff, and then focus on that while still addressing the rest of it? In other words, you can have your most stringent reviews on your highest risk alerts and maybe kick the tires or do some kind of expedited review to make sure you're not missing anything, so that while you still might have 95% false positives, it doesn't hurt you nearly as much from an operational standpoint, because you can still focus your resources on where you have more complex investigations and more risk, as opposed to just treating everything the same and not letting it through. The nice thing about this is I think we have a lot more flexibility to use different techniques. You can use machine learning here. It's kind of the sky's the limit, because it's not how you're providing coverage of the AML typologies. It's just a way for you to sort the alerts that are providing that coverage into buckets that they're best addressed. The final thing I'll say for the monitoring use case is for auto tuning. So this is when I talked before about, okay, hey, you're pulling out cash, and if you have more than $10,000 in cash 3 times a month, generate an alert. Well, all those have to be set by your institution based on your customer base. Usually that's a very manual process where I've got statisticians looking at these things and trying to set them. More and more we're trying to say, hey, can we just auto tune these things, right? Can we set up and have some algorithms which go through and tell us what the right parameters are? And then that can actually help us to stay with the trends in the world over time. Because transactional behavior shifts over time. Generationally, people are using more digital channels now, and being able to automate those processes means that we're better able to. I'm going to go kind of quickly through some of these other ones. I know we're running up on time, but just even in the ingesting stage, I think there's a lot that we could do. So we fall prey to most AI systems where garbage in means garbage out. And so it's really important to get good data sourcing. The more we can describe our data, and the more we have things which can tell us right off the bat where you have outliers or you have changes in behavior that are going in the transactions that are coming into the system, that would help us to adapt our systems to best find the potentially suspicious activity. Right now, it's kind of, you have to do manually monitoring to make sure your volumes are coming in and are appropriate. And then you generate alerts based on kind of parameters that were set maybe months ago. But the more intelligent that you can be with your data sourcing, the more you can monitor the true quality that's coming in and be proactive as opposed to reactive. It just helps you have a better system overall. And then I'm going to wrap up because I know that we are running out of time. There's a lot that can be done with natural language processing, narrative generation, and even auto filing of SARs for specific situations. And I just want to wrap on, like, what do we think the use cases of tomorrow? I'm talking a lot about individual banks and institutions. The more that we can share and have standards and perhaps use things like blockchain to anonymously share information amongst our groups, we might be able to better find and tune these models and share kind of some of these approaches that we're doing. And one day, who knows, with generalized AI, you might even be able to have all of this totally automated and a really small core of folks that are looking at your highest risk cases. But I think we're quite a ways out from that, just in terms of the complexity and really the human intuition part that still plays such an important role in all this. So I know I had to blow through a lot of that at the end really quickly. Sorry, we were running out of time. I just want to say thank you for taking the time to watch my my presentation today. Please feel free. I'm always happy to discuss more and love, making connections. So please feel free to reach out to me in my email or on LinkedIn if you've got any questions or want to discuss further. And I think I'll turn it back over to you, Patricia.
Wow, thanks, Pete. That was amazing. If you could stop sharing your screen, I know this audience wants to give you a huge virtual round of applause. That was amazing, and we really appreciate you sharing your insights with us today. For the audience, it's time for you to make your way to your next session. Along the way, make sure you accept your connection request and take some time to check out our amazing exhibits. Thanks so much, and we'll see you around.